Hello everyone, how's it going? So in this video, we're going to be talking about FNGR, FingerMotion Inc. It is a company that has recently gathered a huge amount of attention for very obvious reasons if you look at the chart. I mean, the price action just went through the sky, right? And this has made a lot of people wondering, can I get some of that quick profit? Or is it already too late for me to get in? And given the fact that we cannot predict the future with 100% accuracy, what can we do to anticipate the possible movements? So we're going to be talking about all of these in today's video. And also, this is a good occasion as any to remind us that just like everything that you may or may not hear on the internet, whatever you read or whatever you receive as information is most likely people's opinions. The final decision to buy or sell or hold a stock must rely on your own conclusion based on information from different sources. Mine is one of them. And that it doesn't really mean that it is necessarily what's going to provide you trading profits. So with that being said, let's move on to FNGR. FingerMotion is a stock traded on the Nasdaq with a telecom and data analytics business in China. Now, they have been operating over many years, and from the appearance on the website, they seem to be some sort of snowflake / Palantir, if we want to compare it to something that we know. And a lot of people believe that this stock could go against the general mood and go through general trend of going downward. And so far, they've been proven right, and massively so. Does it really mean that they're right because they were right for all the fundamental reasons, or is it just because at some point there's a massive technical recovery? I can't say for sure which one is the case for the time being, but I would say that we can be sure that the technical does play for a significant part in it. And going down the road, we also need to look at some other facts about this company, as well as the economy in general, to make up our mind. So some people have suggested that it's maybe a short squeeze that is in play, which looks like it on the price action, because very often what happens with a short squeeze is that a stock may have a significant amount of short positions. Short positions aim to profit if the stock goes down. And in the meantime, they would have to pay financial costs to the broker to keep their positions open. If the stock goes up, they may be forced to redeem their positions, which acts de facto as a buy action for the stock price. In other words, as far as the stock is concerned, when you redeem a short position, you essentially add demand to the stock. Now, let's take a quick look at the fundamentals. The revenues have been increasing on a year-to-year basis, and the debt has been increasing but slowing down. The loss per shares has been increasing, but this might be temporarily and non-routine. What do I mean by this is that routine losses or routine operations mean that those things are going to occur most likely on a year, year after year, whereas non-routine events may occur once every while because of special circumstances may have arisen. Overall, I would say that for a tech stock, this company has been operating more or less normally according to the norms. Now, with that being said, I'm here analyzing this company and so on, but my feeling is the demand has built up because the price action went up in the first place. It could have been because, it's possible that at some point there were a lot of short positions, and then they went up and so on. With that being said, I tried to check on Fintel, and from what I see, there's not that much short demand. So please let me know in the comment section if you know that this is not the case, that there were actually a lot of short positions being covered and so on. So in this case, I will probably make a correction at a later date. So a lot of people want to jump on the gravy train, and they didn't ask themselves too many questions. They just think that this company is going to be doing very well for them, for the employees, and also for their portfolio. Now, this is certainly a trend, or at least a general mood that I picked up when I was doing my research on FingerMotion. The price will always reflect the current hype and like our current perception of how much this company is worth. The keyword here is current, because the next moment things could very well change. And what I see now is that the downward pressure might not be avoidable, and it's more than predictable in the short term. Of course, when I'm looking at the price action now, it does seem that for the moment at least, they have been able to hold the ground. Does it really mean that they're going to be able to hold the ground forever? Probably not. And also, if we look at like where the price action has been going or has reached in the past, they have reached similar level, and if not much higher. So for example, they have been able to reach around $15 in the past. So this is why, like, I would say that, of course, when you're long a stock, the sky is the limit, or in fact, the sky is not the limit. But we always tend to look at the past for clues about resistance and supports. Like, that's just how human brains function, right? And also, this is how very often trading decisions are made. Oh, is it near like a support level? Is it near a resistance level? And so on and so forth. So for now, its current level might be a resistance. And the next one seems to be around like the region between $12 to $15. This, of course, is one of the many scenarios. And personally, I would say that the odds for them to reach 10 or 15 is not non-existent, okay? And I would say that it's material, meaning there's a real chance that this could happen. However, it's the Bionano Genomics in the late 2020 kind of situation, where they went from a penny stock to something like 10x. But it's not going to happen every single day with that many stocks, right? So yeah, of course, we can keep it in mind, but it doesn't mean that it should be the main scenario that we're relying on. When we look at the company, it seems to have like a hybrid business model, which is smart in a way, but also a little bit dubious in some other aspects. Let me explain. Its clientele seems to be both retail and businesses. The retail users would use like their services and their device. So they seem to be like a telecom company. And even though they didn't say this, in fact, not only would they not necessarily say this, but I think that they might use the data of the retail users to like improve their understanding about like stakeholders and clients. Is it really legal? I would say that they might be smart enough to play in the gray area. But this is, of course, something to keep in mind as we go forward, because it's possible that this thing could really start to bite somewhere down the road. So basically, I think that the main bread and butter for this company are the businesses. So it is a mainly B2B type of thing for its development potentials. That is maybe just my opinion. Maybe a lot of them are also retail, but I think that going forward, the data portion of their business is likely going to be the main like growth factor. The other one is the equity composition. So I feel like when like the shareholders are mainly retail, which is the case for about 99% of them, this is something that should send us a message. It does suggest that people are mostly putting money in this company due to the short-term volatility. And this is why I would say that the stock, at least in its current stage, is good for trading. I'm really not sure if holding it at the current time, at the current price level, is necessarily a good idea. It's very obvious why it's not a good idea regarding the price. I'll try to be as clear as possible regarding the timing, because this is not very explicit. Basically, have you guys ever wondered or worried about ADR stocks getting delisted on American exchanges? And this can be done following an actual procedure. Like, for example, if you want to take a company private, then you have to redeem the shareholders at a certain, probably at a certain premium. In fact, this is what Tesla almost wanted to do when back in I think it was 2019, he tried to take Tesla private. He said that there's enough money, and there actually wasn't, and it was like a whole big scandal with the regulators and so on. People have maybe forgotten a little bit about this. But anyway, that's not the point. The point is, when taking a stock private, very often you need to pay a little bit of premium for the shareholders. But if the shares are simply traded from one exchange to another, then it's a different story, because technically the stock is still like a public company. It remains tradable on public exchanges. It just depends on which public exchange we're talking about. Like, for example, if we're talking about the American ones, they are probably the most complete and deepest capital pools in the world. You can put it in FTSE, you can put it in DAX, you can put it in CAC 40, but there's going to be a difference in terms of how much money you can expect to raise. In other words, how much valuation you can squeeze out of a company's value. The American exchanges are, or at least tend to be, by far the most generous in this regard. If those companies are traded in other exchanges, this is an additional risk factor that we have to evaluate before we go in. And also, once those stocks, they move from one exchange to another, there might be a currency risk as well. So for example, if it is listed on the NASDAQ, then it is traded in US dollars. If it's traded in the TSX, it's traded in Canadian dollars. If it's traded in FTSE, it's traded in I wanna say British sterling, but it's like tens or hundreds of pennies. Anyway, the way that they present it, it's not in units of sterlings, right? I think it's in cents or tens of a cent. So there will be differences in how much money you can get, but also the fluctuation of those currencies. I mean, for years, the British sterling was listed at around $1.60. Like the GBP USD pair has been around $1.60. But recently, they're heading right for parity or something. So, and by the way, we're not going to start to talk about the reasons why a currency pair might collapse or might jump. This has to do with the country's monetary policy, and also how's the inflation, what is the central interest rates, so on and so forth. For the United Kingdom, things have been a little bit more delicate as of late. I remember that there were true worries about NEO. And those worries, even though for a long time people were saying that, okay, you know what, they're kind of exaggerated, it's not going to be that bad, there's too many stakeholders in something for this kind of stuff to happen. Well, there are actual companies that were delisted. Maybe not privatized, but they were definitely delisted from the American stock exchanges for reasons that are outside of the scope of economics, right? But they might still be traded in other exchanges using other currencies. And then it's a question of, do you want to move to the other exchanges? Because it's not a given for many people to switch from, let's say, US to Singapore or US to Hong Kong, to Nikkei, to, the DAX, or any other smaller exchanges. So it also bears the question, like, do you really want to invest your money in those markets? With FingerMotion, see, the thing is, they've been there for a long time. They've been there at least since like 2017 and stuff. So maybe they won't be affected as much, but it's something to keep in mind. The other thing is FingerMotion's business model. They are relying on telecom. And by telecom, I mean, they also provide like 5G services and data analytics or data processing. Those two areas, one, they might be heavily regulated or relatively more heavily regulated compared to other industries. And two, there might be like hard limits as far as how far they can go before the red tapes start to kick in. And by red tapes, it's not just going to be, oh, you cannot do this. It could also be, well, you shouldn't have done things that you've already done, and for which you've already incurred expenses, right? So these are like some of my concerns with holding FingerMotion going forward. By holding, I mean you no longer consider the stock as a trading opportunity. You consider the stock as something that you want to hold on for years to come because you think that it's going to grow into something that's going to be much better. I mean, for now, I'm willing to be proven wrong, by the way. But for now, I would say that the main appeal for FingerMotion is the active trading part. Like, for instance, given the current price level, I think that amongst the two possible scenarios, going up or going down, the going down one is higher, relatively speaking. Because even if we don't have any particular reason to send it lower, just because a lot of people are cashing out of their positions is reason enough, right? If they go up, I would say that it's better to keep a small, but a very small portion of the amount you're willing to allocate to FingerMotion in order to profit from this increase. And in that case, I would say do not add additional shares in it, because this kind of price dynamics very often do not last very long. And you would have like a very painful wake up procedure if it stops going up and goes back down. I mean, a lot of people bought Lucid, like Lucid Motors, back when it was in the 50s or the high 40s. I mean, I hope that you're not one of those, right? That doesn't mean that a company is bad, not necessarily, but it does mean that the hype might be gone. So definitely be careful with that. If FNGR goes like way beyond where it is now, I would say don't put in additional exposure in the stock. Maybe aim for something like 100% or 150% in profit target, cash out, and wait for retracement. I don't believe that, let's say, if it goes from where it is now to like $15, is going to be a sustainable move. They haven't been able to do this in the at least 5 years of their existence, right? So personally, I feel like these are some of the necessary cautions that we need to exercise if we want to buy FNGR. Now, should you buy FNGR? First of all, I would say that if you cannot control your FOMO, but you want to have a piece in the game with FNGR, then go for it. If you're super risk tolerant. You don't mind trading, very small caps or penny stocks, and that you're used of volatilities that are like 50, 60% up or down, then go for it. And also, if whatever you're willing to put into FNGR, it needs to be the kind of money that you're willing to lose. It's the case for every single stock, but in this case, what I actually mean is whatever you lose with FNGR, you can easily make it back almost with the passive income of your other holdings, right? So for example, my Palantir position is now losing a certain amount of money, and I would say that it would take about not 2 months of dividend, interest, and other cash distributions from my other holdings to plug it back. Okay, so that's what I mean. Yeah, it's not fun, right? It's not fun because what that does is that it eats away your profit, but at least you wouldn't be losing a huge amount of it. And I would also recommend to buy it for about 0.5% of your portfolio. Don't risk more than that. And even 0.5, I would say, is the absolute maximum for this position. As far as the FOMO and the retracement part is concerned, I would say that it's 10% as an initial position, and then the remaining 90% should come in as a dollar average down. And of course, you don't do it with a straight line distribution, right? If you see that the stock seems to have bottomed at a certain level, then you put your money in. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.